Welcome to video T3C on uncertainty. This is really just a slightly deeper dive into the same present value of after-tax cash flows model we worked with in the previous two videos.
So here is our model. Pre-tax cash flows minus taxes are after-tax cash flows. And we know that we can restate this as after-tax equals pre-tax times 1 minus the tax rate. As we know, this means that after-tax cash flows are a function of pre-tax cash flows and the tax rate. When we use this for forecasting purposes, we have to predict both future cash flows and the future tax rate. The book describes 3 types of uncertainty to consider: audit risk, tax law risk, and tax rate risk. All 3 of these affect our predictions of the tax rate. Of course, the pre-tax cash flows introduce a bevy of uncertainty on their own. I will leave that concept to your finance course. Audit risk relates to the ultimate success of whatever tax planning strategy a taxpayer employs. Obviously, if the tax return is selected for audit, and the underlying tax strategies are found to be deficient and result in a greater or less tax, the predictions will be erroneous. For example, a large pharma company, Glaxo, had been using a tax strategy whereby the high tax division in the U.S. was paying royalties to a low tax division in a foreign country, and thus reducing both U.S. and the global tax bite. Unfortunately, the IRS audited Glaxo and determined that the charge to the U.S. subsidiary was overstated, and ultimately Glaxo settled with a tax payment of $3.1 billion. I'd say they missed the forecast by this much. The second risk is tax law risk, which we have discussed previously as uncertainty with respect to tax efficiency. Tax law is written by Congress and is subject to change at a moment's notice. What is tax law today may not be tax law in the future, and vice versa. Certainly, the tax law change that took place in late 2017 is proof enough of this. Thus, there is always some element of risk knowing that the tax law could change, for example, limiting a deduction. Lastly, changes in tax rates can affect the future, as we saw with an example a couple of videos ago. We can repeat a similar example now. Here is our friend Mercedes facing that same deduct now or later scenario. Except in this case, she knows that the tax rate is going to increase next year. Let's take a second to read the problem. Normally, we would accelerate deductions. However, it could be that the tax savings increase that results from the higher rate can subsume the time value of money effects. That means that changing rates, depending on the direction of the change, almost always warrant an analysis beyond accelerate deductions and defer income. Sure enough, in this case, the tax savings does overwhelm the present value, and taking the deduction in the following year with the higher rate makes more financial sense.
You made it to the end of the video on uncertainty. The next video is on markets and taxes. Thanks for watching.